Hello there, welcome to another live webinar with us from Blue Futures. And today, what are we going to be discussing? We are going to be discussing the market outlook for 2022. Who who do we have in the studio? It is none other than a professional trader, Daniel Ang, who's going to be walk us through his insights for 2022. And there you can see on the picture right there, that's Daniel himself. Let me tell you a little bit more about what we are going to cover today. Daniel will be walking us through the major themes, outlook, and some potential opportunities that investors and traders should keep an eye on. Some key topics to be touched on by Daniel include global inflation, a hot button topic in everyone's mind, rate tightening cycle, the US dollar, US indices, and gold. And these more or less wraps up the key themes that Daniel will be covering today. And who is Daniel? Daniel began his career as a commodity broker in 1985. That's some time ago, so he's vastly experienced. He then progressed on to trading equity index futures in the late 1986 and became famous for making a successful trading call when he shorted the Hang Seng Index in October 1987 in what was later termed as Black Monday. He then became a gold dealer in 1989, was an FX trader with Stanchart in 1992, and held the position as vice president. He ended his career with FIMAT Asia, brokerage arm for Société Générale S.A. at the end of 2006, and subsequently he became a full-time trader, and he still is today. Daniel, if you're all set to go, can I hear you say hello just to check whether your mic is all set up?
Good evening to all of you. Hope you can hear me.
Yes, we can, Daniel. Members of the audience, if you can hear us loud and clear, just head down to the question box, which is on your control panel. Somewhere at the bottom, you see a pane for questions. Just type yes in there if you can hear us loud and clear. All right, just hit your question box and type a yes in there if you can hear us loud and clear. All right, thank you, Kavita. Thanks for confirming that the sound is all good. Daniel, if you're all set, I'll hand the reins over to you, Daniel.
All right, and a good evening to all of you. And time has really passed, and we are already in the second month of the new year. And right now we are in the midst of the Lunar New Year. And first of all, for those celebrating the Chinese New Year, Happy New Year to all of you. May the year of the tiger prove to be bountiful for all of us. All right, without much ado, let's get started. We have a lot to cover today, and try to cover as much as I can. All right, and the first thing I want to do is, of course, to remind you that today's presentation is definitely not an offer to buy or sell any securities, and trading of any kind of leverage products like futures, options are definitely highly speculative in nature, and therefore they do carry the risk of losses. Now, attendees are hereby advised to consider their own risk tolerance and suitability before trading any kind of leverage financial instruments. Later on during the market outlook, I'll be sharing with you my views. These are, again, my opinions and has got nothing to do with my company, Traders Academy International. Therefore, I will not be liable for any action that you may take as a result of attending this presentation. Now, to get started, I'd also like to cover quickly what we will be talking about tonight. First of all, we'll be talking very briefly about global inflation. Right now, we are definitely in the inflationary cycle. And as a result, central banks around the world has been responding. We are definitely going to look at a rate tightening cycle that we are in right now. And of course, I would be remiss to not also mention that while the major central banks are talking about hiking interest rates, there are some major central banks that are actually going the opposite way. Okay, so that there lies the policy divergence that I will talk on briefly and what consequences it may have as a result. and how you can position yourself knowing that there will be monetary policy divergence among the central banks. Okay, then the other thing that we have always been talking about, of course, is US, and right now we're going to spend a little bit more time to talk about China. China economic slowdown is here to stay and is likely to progressively get from bad to worse. So what implication would that have for us as a whole? Okay, and last but not the least, I will talk about what's happening at the Russian-Ukraine border and what implication it may have if the tension boils over. And of course, I'll be talking about what instruments you can actually use within the CME suite of products in which you can take advantage of based on the fundamentals that I'll be covering tonight. And of course, the last section will be an outlook on US equity indices, in particularly how to use the CME Micro E-mini equity index to take advantage of the volatility that's coming. And when we talk about inflation, it's of course it is definitely a topic that we have to cover. We talk about energy prices, and crude oil is definitely a product that we can actually take advantage of. And this is also something that I also like to cover because of the policy divergence in the monetary space. The major FX pairs is definitely going to move, and which pair should you be looking at when all this come to pass. Last, we will have a 10 minutes Q&A session. And so please, if you have any question, just hold on to your horses and type your question into the chat box, and we will deal with them at the end of this presentation. Now, this came in this morning in Yahoo. This news came in and said the US stock pressured by worries on inflation and Ukraine. These are exactly the two main themes that we'll be covering tonight: inflation, as well as the geopolitical tension facing Ukraine right now. Okay, so this is something that is very current, and I would like to bring your attention to this as we go along. Okay, first of all, we're going to talk about the inflationary situation that we are facing. Since the first quarter of last year, especially in the States, we have been seeing the re-emergence of inflation for quite some time. Since the 2008-2009 financial crisis, the world has been trying to create inflation, but there has been no success until last year. Okay, last year, if you remember clearly, we have Joe Biden came in as the 46th US president, and the first thing that he did, among the many things that he did, was to launch a series of very large, very high ticket physical stimulus package, okay, in the trillions of dollars. And a lot of analysts has been saying that that is possibly the catalyst that that sparked the inflation that we are seeing over the last 10 months or so. Okay, so this is exactly where we are right now. Inflation is here to stay, and of course there are many reasons why we have very stubborn inflation, and inflation seems to be getting from bad to worse. Of course, we have the global supply chain disruption as a result of the lockdowns in response to the COVID-19. Okay, that is one major factor. The other one is, of course, the very large stimulus package rolled out by the United States to also as a response to the COVID-19 slowdown in the economy. So when we are looking at both, it could very well be the two catalysts that cause the inflationary cycle that we are seeing. Now, you can see on the chart on the right, you can see there are many countries that are definitely seeing very elevated inflation. Tomorrow, we're going to see the CPI numbers from the United States. So I don't have the latest. This is up to December So the January figure will come out tomorrow. So we will have to see what's happening. But if you look at Europe, Europe has actually come off a little bit. You can see that some of the major economies in the Eurozone, like Spain, like Germany, like France, you can see that the inflation has dipped down a little bit, okay? But by and large, you can see the trajectory is still pointing higher, okay? And if we have an escalation at the Russian-Ukraine border, you can be very sure that this inflation is going to spike even higher, okay? So this is a global phenomenon. Elsewhere, you can see China China inflation is only 1.5%. So by and large, if you trust the number coming up from China, definitely inflation is not an issue right now. But definitely, if you read at local reports coming in from Chinese media, definitely the situation on the ground is a little bit different from the official numbers. So by and large, we're definitely going to see inflation. Okay. Now, going forward, what about US inflation? US inflation right now is at a almost 40 years high. This is 39-year high. Okay, so you can see the last number that we had, the consumer prices up to December 2021 is at 7%. Now, if you ignore the energy prices and food prices, which is what you call the core CPI numbers, is at 5.5%. 5.5%. Even that is even very, very high. So you can see that regardless of which index that you look at, definitely we are seeing very high inflationary numbers. Now, if you use the old computational method used by the Department of Labor Statistics back in the 1980s, this number is definitely in the double digit. Okay, people are looking at 15%. Of course, statistics is always used to definitely to wrap around certain narrative. Okay, so right now we can see that even at 7%, it is exceedingly high. We are looking at inflationary numbers like what we have probably seen back in the 1970s. For those of you who have lived through 1970, you will know the United States have seen a wave from inflation that was so high that the then president of the Federal Reserve has to hike interest rates to double digit, and that is very scary. Can you imagine interest rate at double digit? Okay, although it is unlikely to happen now, but what we are seeing here is something very similar, and the severity of this inflation cannot be ignored. Okay, now on top of the high inflation, the latest number we coming from the US job numbers seems to be indicating unemployment rate has been coming down. The last we get is 4%, okay, which is a little bit higher than the month before, which is at 3.9%. So by and large, you can see that after the surge at the in the aftermath of the lockdown in 2020. Okay, you can see that unemployment rate has been in the States has been coming down gradually, and we are now at a more sustainable levels. Okay, and of course, when you look at non-farm payroll, we also want to see the exceedingly good number that came out last week. Okay, last week we have the first non-farm payroll for the month of January. Market was expecting a lousy number, okay, something like 150,000, but the number came out exceedingly good at 467,000. That took the market by surprise, okay. And on top of that, we have a revision for the month before, okay. December number was revised from 105 to something like 510. How could they got it so wrong so badly? Okay, so when you look at numbers and statistics, you always have to take it with a pinch of salt. Okay, market is always reactive when they look at numbers. So don't just look at the headline numbers. The other thing that we should be also concerned with, although the unemployment rate has been fantastic, the number of jobs being created is definitely very good. Okay, that points to growth in the US economy. On the one hand, while there is growth, we also have to consider about the rising wages within the United States. Now, this is more of a problem because once wages start to climb, it is almost impossible to bring it down. Okay, so that will add into the inflationary story that we have been seeing all this while. Okay, so the current, on average, the hourly earnings about $31.63. This is the highest we have ever seen for a year now. Okay, so is it going to be even higher as we go forward? Definitely, if we have been reading the news, we have been told that U.S. employers is having difficulty getting staff. Okay, so right now there is, although the unemployment rate has come down, but there is a huge shortage of people actively looking for jobs. Okay, so that is a mystery. While the unemployment rate has come down, the number of jobs created has actually gone up, but there are still stories about companies not able to hire, okay, and they have to pay higher wages just to entice people to come to work, especially at the hospitality sector, okay, places like restaurants, bars, and all these front-facing consumers sectors definitely are still having problems getting staff at the price that they can hire. Okay, now when we look across the Atlantic, we see that inflation is not only a US story. Over at the Eurozone, they also have the same story. Now, the Eurozone HICP refers to the Harmonized Index for Consumer Prices, is also at a record high, 5.1%. This is the latest coming out for January. So we can see across the Eurozone, inflation is definitely an issue, and energy is one of the biggest component that is affecting inflation at the Eurozone. So right now we can see energy prices, whether it's crude oil or energy products, has all been surging. And then on top of that, we have this tension at the Ukraine-Russia border, and that is adding that is definitely the fuel that adds to the fire. So going forward, we do can expect higher inflationary numbers, and the key here is what are the central banks going to do. Okay, first of all, when we look at the Federal Reserve, US has just ended their first FOMC meeting for the year. That was only quite recently, 1 month ago. We can see January the 11th, they finished the first FOMC meeting, and the language they use has turned hawkish. Okay, and now at the bottom there, you can see that I underline that the current chairman of the Federal Reserve, Jerome Powell, did not rule out as many as 7 hikes in rates of a quarter point each. So this is a very, very hawkish view, okay? Because if you remember earlier on, throughout the whole of last year, he has been talking about no hike in interest rates for until 2024. Then a few months later, he said maybe we will start to hike interest rate in 2023. Now we are looking at no less than 7 hikes possibly this year. So this is a very hawkish, more hawkish than what analysts has been thinking. Okay, so the most hawkish that I've read is 4 rate hikes for this year. Okay, but I think the chairman has outdone himself, and he has dropped hint that he's going to be definitely looking to be very, very hawkish as far as the rate tightening cycle is concerned. Okay, now across the Atlantic again, we have a different take. The ECB has always maintained, as far as the president of the ECB, Christine Lagarde, has been always saying that she is not confident that the ECB is going to hike rates until at least 2024. Okay, but you can see that the HICP in Eurozone has been at 5.1%. I think she's having second thought, and maybe he says she won't rule out any rate hike this year. So, but by and large, she is not as hawkish. In fact, the reason why she has been saying that is because I think at the end of the day, the ECB has painted itself to the corner. We need to say that they have very little monetary policy option left. Interest rate is at negative. They have been putting interest rate at negative since 2014, and that has not caused a boom in the economy. So right now, I think they are in that same cycle as what Japan used to see back 30 years ago. Very aggressive rate cuts cannot resuscitate the economy. So right now, I believe they have very little option. In fact, I don't think they have any option left, because interest rates are negative. And if they don't hike interest rates, definitely they don't have the tool to tackle the inflation that's currently surfacing in the Eurozone. However, if they hike interest rate, they're going to blow themselves out of the water, because by now the ECB has become the largest buyer of bonds within the ECB, okay, within the Eurozone. So they account for about 40% of all bonds being sold. Okay, so if they stop buying, there will be no buyer, and you can imagine what will happen if the market, with the basement taken off them. Okay, basically what we will see is that the market will implode. Okay, so right now they do not have any option to raise interest rate, because that will mean that they will blow up their national debt. Okay, so right now the Eurozone is in a very, very uncomfortable position. Okay, on the one hand, there is very high inflation. On the other hand, they do not have the policy tool like what they have in the Federal Reserve, because Federal Reserve did not cut interest rate down to negative. Now here you can see there's a chart on the right here. We show you the current effective interest rate differential between the two major central banks. We have at the top the Federal Reserve interest rate. Currently, the Fed fund rate, okay, the effective Fed fund rate is at 0.08%, and you can see that the ECB is negative 0.578%. Okay, you can see that the difference is already quite wide. So imagine if they are not going to raise interest rate and if they allow interest rate to stay at a negative territory, whereas the Federal Reserve start to hike interest rates, even not as aggressive as what the Fed chairman has been implying. Any rise in interest rate at the Federal Reserve is going to cause capital flight. Okay, if you are the European institutions, especially a pension fund or a bank, what will you do? Because if at the end of the day, if somewhere else is having a higher yield, you will definitely want to park your money in that whatever instrument there is that going to bring you higher yield, where domestically we have negative interest rates. So the policy options for the ECB is actually quite stuck in the sense that if they maintain at the current rate of interest, whereas elsewhere in the Federal Reserve, okay, interest rate is rising, that means that the differential in the interest rates is going to widen and the money is definitely going to flee Europe. Okay, when that happens, we can see a lot of assets is going to move. Some will favor the United States. And where would the money go to? Once the money goes into the United States, obviously they are not going to be parked in the bank. Okay, they definitely have to be invested. Okay, and most of the money will go into risky assets, and that means equities. Okay, so do watch out for this key theme here. Okay, on the other hand, we have seen China GDP has been slowing very sharply. Of course, in response to the COVID-19, we have a negative 6.8. Now we have a very sharp rebound up to 18.3 in the first quarter of last year. And the last number for the Q4 of 2021, we can see the GDP in China has slid back to 4%. It is still very respectable, okay, at 4%, because at the end of the day, elsewhere they are not even producing 4%, okay. But when you look at China, China is a very different case altogether. They need at least 6.6% to maintain a healthy growth. So I think China is definitely very worried that the world is going into a rate tightening cycle. Now, if the Federal Reserve do act on whatever they have been telling us that they're going to hike interest rate aggressively this year, that will mean that there will be a lot of capital moving out of not only Europe, I think from all over the world, especially emerging markets. So China is the largest emerging markets. So if capital flee Asia, flee Europe, they will have to go somewhere, and I think that somewhere is definitely towards the United States, where the interest rates, is going to rise, and if that being the case, dollar is going to rise as well. So for emerging economies, that is a big worry. Now, if you look back at the Asian financial crisis and back in 1997, we have already seen the negative impact if suddenly foreign funds actually pull out from the region. Okay, so are we seeing back the same kind of scenario that we saw back in 1997? I think there's a very high likelihood the emerging markets, including the most of Asia, is definitely going to feel the pain. Okay, the currency is definitely going to move, interest rate is definitely going to move. Okay, so the other thing that we also know that Chinese is worried, because we have the president of from China, Xi Jinping himself, actually mentioned at the recent Davos, of course it is online, that he actually mentioned at the World Economic Forum that if major economies take a U-turn in the monetary policy, meaning to say that if they hike rates, there will be serious negative spillover that will challenge global economy and financial stability. So this statement itself is telling us the Chinese are also worried, because not only are they concerned of the rising rate tightening cycle, China has a slightly different worries to contend with. Okay, we have seen on the same day when this statement was actually made, that China has actually not only cut interest rates, they actually allow the reserve ratio to be loosened up a little bit, meaning to say they want to boost the local domestic economy. So with a rate tightening cycle, I think that will be difficult, very difficult for China, and that will cause a lot of complications going forward. Okay, earlier on I did mention that the emerging economies are very vulnerable to any kind of rate tightening, because over the last over the last 2 years, okay, US interest rate is at rock bottom and the dollar has been cheap. So not only companies has been borrowing quite a fair bit in US dollars, and now with rates going up, okay, the burden on their outstanding loans is going to go up. Okay, not only that, because they have borrowed in US dollars. If the US dollars also rises on the back of higher interest rate, that will be a double whammy, okay? Meaning to say that it's going to be very difficult to service the outstanding loan. So the emerging markets is very, very vulnerable, okay? So do understand that is this thing that is the undercurrent that is underpinning the market for this coming year. Maybe it will stretch all the way to next year. The other thing that we would know that the money is moving, capital is moving. Now, this is the US 10 years Treasury yield, meaning to say that the US government periodically will borrow, okay, by issuing short-term bills, medium-term notes, and of course, the long bonds for 30 years, okay. This is a 10-year Treasury note yield, is middle of the road and has always been a bellwether, okay. When you want to look at interest rate in the States, the 10-year Treasury yield has always been a benchmark, and you can see that it has been rising very steadily since the third quarter of last year, okay. The current price, the yield is just under 2%, okay. So if the US Treasury yields hit 3%, I think we are definitely going to look at a major dislocation, because if they have to have such high interest rates just to entice people to buy American Treasury, it means that capital has been fleeing and getting out of risky assets into risk-off assets like bonds, okay. So bonds market, we can see the bond has actually come off and the yield has actually gone up, because in order to entice people to buy, you have to pay higher interest rates. So this is exactly what we are seeing. The magic number here will be 3%, okay. If the market hit 3%, all bets are off, okay. The meaning to say we are going to see a very painful period. Now, on top of all this economic situation that we are facing, okay, the other biggest elephant in the room is obviously the geopolitics between Russia and Ukraine, and more by extension to the West, okay. Russia has been massing huge amount of military assets and basically has surrounded Ukraine, although they have not signaled that they're gonna invade, but that has been the story for the last few weeks going into the new year. So January has come and passed. By February will be the most important and most dangerous period, because for Russia to actually decide to invade, they're going to move the mechanized division across the border, and they need to have very solid ground, and they need the land to be frozen in order to move their heavy armored column through the various part of the border. So February will be a key period. Whether they will or they will not invade will depend, I think, very much on February, which is this month, okay. So what impact does it have? Already without invading, we can see the energy prices has reacted. Now, don't forget, Russia supplies about 40% of Europe's energy needs, okay, and that is causing a lot of nightmare for them. What if Russia decided to turn off the gas? And how would Europe go through this very cold winter? Right now we are in the middle of winter, and of course right now we have seen that US has been making arrangements, trying to tell Europe to divert away from Russia, to buy more American natural gas, as well as buy from Qatar. And right now Russia has actually built a couple of what we call pipelines that will supposed to supply Western Europe, okay. But apparently this is definitely something that US does not want to see, because they do not want Europe to be dependent on Russia for such an important commodity like energy, okay. But they has been threatening to turn off not allowing them to supply through the various pipeline, okay. They have the latest pipeline is the Nord Stream 2 pipeline, which have not been operational yet. It has been built, but the Europe need to certify it, and looks like in order to put out a brave front, they are saying that if Russia ever invade, then they are not going to allow the natural gas to go through this Nord Stream 2, okay. So again, that is going to cause a supply issue when the demand is rising and supply is not definitely increasing. We can see that the price have reacted to the north side, okay. Germany depends on Russia gas for 30% of the economy. Now, Germany is the engine of Eurozone. So if Germany cannot grow, the rest of the other member nations definitely will be very, very vulnerable. So we are looking at a very serious situation in Europe itself. So if whether it is geopolitics or whether it is the economic front, both are not looking too bright. Okay. So this is also something that just came out not too long ago. You can see that they are already having to review contingency plan for where to get energy supply. They are going to look at the United States, but whatever the US can supply them is going to be a drop in the bucket. They need a lot more. Even Qatar has to ship their natural gas to them. Basically, I think the option for them is not very rosy. Okay, and within the eurozone we have some that has already said, look, I'm going to deal with Russia. Now Hungary has already looking forward to having some kind of more stable supply from Russia. So within the eurozone, within the EU, within NATO itself, we can see that they may already be fraction. We can see fraction developing as far as energy needs is concerned. So do watch out on this front, okay? Because I think energy prices we haven't seen the high yet, although it has broke through $90 per barrel. But I think very soon we will definitely be seeing the magical number of $100 per barrel. Now, there are various instruments within the CME suite of products that you can actually take advantage of this current situation we are in. Okay, if you have a view, definitely you can have instruments that will suit the purpose of taking advantage of all this that's happening within the economic space as well as geopolitics space. Okay, first off, we will want to talk about the very successful product called the CME Micro E-mini equity index products. Okay, I started trading the S&P 500 back in the late 1990s, and that was currently what we call the regular contract. In those days, there's no E-mini, there's definitely no Micro E-mini. So the Micro E-mini has come around because the notional value of the index, okay, has gone up by leaps and bounds. Okay, if you use the notional value and use a percentage as margin, definitely the products will be out of reach for the typical investor like you and me. So the whole idea of launching the Micro E-mini products, okay, is definitely to cater to investors like you and me. You can see that the size of the contract itself is only about 1/10 the regular size. Okay, so you can see that the price is also very affordable in terms of margin requirement. If you have any intention to hold any position outright overnight, you can see the S&P will put you back $1,150. But however, if you're doing intraday trade, it's very affordable because it's only $140. Okay, you can see that that is possibly the most affordable equity index for intraday. The other one, of course, will be the Russell 2000. Is also at $140 for intraday. But if you look at overnight position, it is possibly the most affordable at $650. And it's no coincidence because over the last few months, you can see there was a surge in trading volume for the Russell 2000. Okay, so the other index that has been hogging the headline of late has been the tech stock sector. Okay, Nasdaq 100 is definitely not the Nasdaq composite that we're talking about. It is a selection of 100 companies within the Nasdaq Composite Index, and you can see that has also gone up in trading volume. The overnight position is definitely more expensive on the relative basis. Is $1,700 for overnight trades and $230 for intraday. Now the other one, of course, is the Dow Jones. The Dow Jones has always been the bellwether for money managers. So if you are a hedge fund manager, whether you are a pension fund manager, you definitely want to trade the Dow. And it has always been out of reach for people like you and me. In the early days when we trade the equity index, the Dow is not tradable. Nobody offer any products that is linked to the Dow. Okay, now we have the ability to trade the blue chips by way of the Micro E-mini Dow. Okay, you can see that the index itself is 0.50 cents per times by whatever the value of the index, and this is definitely something that you can take a look at. Okay, the margin required is only $900. Intraday is only $150. So these are the 4 most actively traded equity products within the CME suite of Micro E-mini equity index futures. Okay, the other one, of course, you can also trade like I said earlier on, energy is definitely a key theme here. Energy prices has been rising steadily since the bottom of negative $40, which is a fluke. Okay, we have seen for some reason that cannot be explained, crude oil prices has plunged into negative territory at negative $40 per barrel, and since then the market has been rising and rising. Okay, currently we are looking at just above $90 per barrel, and today we have a little bit of a dip, but by and large it is still above $90 per barrel. You can see that you can access this product by way of the NYMEX E-mini WTI crude oil. This is the E-mini, which is 500 barrels per contract, which is 1/10 of the size of the regular contracts. Okay, and the margin required for overnight trade is 3,075, and the intraday is 175. Now you can trade something that's more affordable, more digestible, which is the micro E-mini WTI crude oil futures. You can see that it's only $100, 100 barrels per contract, and each tick is $1. Okay, every 1 cent move is $1, and you can see the margin requirement is definitely more in line with what we can afford. Okay, it's $615 for overnight trade and $35 for intraday. Very, very affordable. Okay. Now, the other one that I want to show you is the micro FX futures. Okay, micro FX futures. If for those who have been trading FX, you will understand that the currency market is by far the largest asset class in the world. Okay, every day, on the average, $6 trillion has been traded within the FX market. So to capture a slice of this currency market, they have launched these micro FX contracts. In the early days when I was trading currency futures, you have to do a bit of a mental somersault because the price are always in inverse, meaning to say that they are reciprocal of the spot rate. Okay, so when you have an idea of whether it is the yen or the Canadian dollars, you have to do some kind of mental somersault because it's a reciprocal of the spot rate. Now you can trade as if you are trading the spot market because the pricing is exactly what you see as per the interbank rates. Okay, now this is the symbol here are based on micro 6E, 6B, 6A. So you can see that these are relatively very popular products, especially for euro dollars, sterling, as well as the Aussie dollars. These are very popular contracts, and you can see the margin requirement is very, very affordable. Now, do understand that this will end up in physical delivery. So be very careful if you do not want to end up in the situation whereby you have to actually deliver. Make sure you roll over before the contract ends or to close out the position, because holding beyond the last trading day will end up in physical delivery. Okay, just be sure of that. Now we are coming into the portion where we are going to briefly talk about the market outlooks, and of course I will be covering the equity index. The Dow Jones, like I said, is the bluest of blue. It's the blue. It is the what you call that? The equity index that's being monitored by money managers. Now this is the monthly time frame. I want to show you the monthly time frame to give you a sense of where we are right now. You can see the market has actually gone parabolic. At the bottom of the pandemic itself, we can see the market was at 18,200, and now it has more than doubled to 36,000, almost 37,000. So you can see that the last 2 years we have seen an explosion of values as far as index is concerned. Okay, a lot of companies are at unbelievable valuation. Okay, so we can see in terms of the equity index, the Dow Jones has actually doubled in value. Okay, you can see for the year itself, it did not start off on. It started off on a promising note. In the first week of 2022, okay, we have a new high traded in the cash market just under 37,000, but that was the best it ever did. And since then, the market has been backpedaling. Okay, to date, as of last night, the year to date is down 4%. So we are seeing a new high being traded, but there was no follow through, and now when the market is under a lot of pressure. Okay, so do watch out. Later on, you will notice as I go through the 4 major equity index, covering the Nasdaq, covering the S&P 500 as well as the Russell, you will see that there has been a divergence in the values of the indices by percentage term. Okay, just remember that the Dow is down 4% as of last night. Now this is the weekly time frame. The weekly time frame we have already seen. This of course based on the cash index. the reason why I'm showing the cash index, because you have to take the Q from the cash index, okay? So you can see that the high traded was just under 37,000, and you can see that since then the market has gone down to 33,150, losing almost 800 points from the high of the year, okay? And the market has a bit of a rebound since, and I think going forward, we are definitely going to see a lot of pressure coming in for equity, generally speaking, okay? So the major key support here we are looking at will be at 33,200 and 32,000, the big figure. So we want to say that if this level has been taken up, because at this moment in time, it is still trading above the last December high, okay? Last December low. If the market ever closed below the last December low, which is 34,006, then that will be the first red flag. Right now, even January is a month in which market actually come down, but it did close back above the 34,000 levels, okay? So if anytime this month we see a closing price on a month-to-month basis below 34,000, that will be the first red flag that we are definitely going to see further losses ahead, okay? This is the product that you can actually take advantage of, the micro E-mini Dow. Okay, you can see that you notice that the prices as of last night close, the futures contracts are trading at a discount to the cash. Now that is definitely something you have to watch. When the futures, when you have time on your side and the market is trading at a discount, that is telling us a lot. Meaning to say that market participants are not as bullish as they used to be, because if they are, then they should be trading at a premium relative to the cash index. Right now, they are trading at a discount, okay? And that is across the board for all the 4 equity index that we're going to track, okay? So you can see that the last month's close, last month's low is at just under 34,000 at 33,900. If we ever have a close below this magic number, definitely we're going to see much lower prices going ahead. And the nearby support for the futures contract, this is with referring to the front month, which is the March contract here, is at 33,390 and 32,900. Do watch out for these two numbers, okay? Now, in the S&P 500, we are seeing very much the same thing. Okay, the year started off on a very, very pleasant note. The market has a new high at 4,818 in the first week of January. And when you compare to the Dow is down 4%. This one is down almost 6.5% as of last night. Okay, so between the S&P 500 and the Dow, they have very similar structure. They have new high traded, and market has come off since. Okay, the other two indicators, index, I will show you very, very shortly, have slightly different structure. Okay. Now, this is the weekly outlook for the cash index. You can see that the market also have a similar sell-off from the high of 4,818 to a low of 4,222, and since then the market has rebounded. So by the way, it closes above the December low by the end of January. Okay, January. So now we have a new month, and we are only in the first week of the month. We are going to see how the price is going to react going forward. I think the pressure will come from the other two equity index. Okay, and the price to look out for will be the 4,495, which is the low for December. Okay, do watch out again. If this magic number has been surpassed, meaning the price has gone below this magic number, I think we're going to see progressively lower prices. And the nearby support is at 4,328 and just above 4,000. So the magic number here is about 4,000. So this is the futures contract for the E-mini S&P 500. This is by far the one that has very, very high liquidity, very good for intraday trading. If you are a scalper, this is definitely a market that you want to zoom in as well. Okay, so in the settlement is here, you can see that the price is trading at a discount to the cash, and overall you can see that the market has lost some momentum after the sharp rebound in the last week, in the last 2 weeks of the January. Okay, so right now we are losing a bit of steam, and you can see that the area that I marked up 4,492 and a quarter, that is the December low. Right now we are trading just marginally below this level. So whether or not it can go back above and close back above this level, it remains to be seen, but I think it's definitely going to be a lot of pressure. Overall, the underlying bias is definitely suggesting that the bull market is by no means over. Okay, for that to happen, for the bull market to be over, I need to see a price traded below 4,000. Okay, and if we have a price below 4,000, then the entire outlook will turn bearish, at least for the medium term. Okay. Now, this is the Nasdaq Composite. We know that the tech stock has been in the news of late. You can see that year to date is down 11.5%. This is huge. And by definition, if you have a correction of more than 10%, the market is in a correction phase. Okay, so the Nasdaq at the current moment is definitely in the correction phase. So this is going to put pressure on the other two indices that we have just covered. Okay, so going forward, this is definitely below the December low. Okay, in fact, if you look at the price itself, I think we are somewhere near last June prices. Okay, so that is the perspective. Prices are already trading at last June prices. Okay, so do watch out for these further losses that you can see coming in for the tech stocks. Now, this is the weekly time frame for the cash index. You can see that we definitely have a counter trend in place, and the key level to watch will be 14,860. That will be the December low, and right now we are trading below that level already. Okay, 14,015. So we can see that we are very far away from where the December low was. Okay, so this is the first inkling that all is not well, and the major support will be at 12,000, followed by 11,100. That level must hold. I think there's a good chance market will actually drift or even move very quickly to those levels in the coming weeks and months. Okay, here's the December contract for the Nasdaq 100 contracts as well. We can see that definitely that we are already in a bear market for the medium term. When I say medium term, I'm referring to the daily time frame. So here, because you can see that the color of the boxes that I have developed, pink is for bearish market and green is for bullish market. You can see that the bigger box is a pink color boxes, and it's telling me, at least in the medium term, the market has turned bearish, and the rebound for 13,700 is definitely what I call a technical rebound. So by and large, I am not too optimistic about the tech stock as far as the Nasdaq is concerned. Now, the other one that we want to watch is the Russell 2000. It has never been very popular for whatever reason, but of late we can see that during the pandemic, a lot of companies have been listed in the Russell 2000. These are basically the small cap companies, and it has been getting a lot of attention. And over the last few months, we can see a surge in trading volume for the futures contract linked to the Russell 2000. So this is also another product that you can actually take advantage of. Remember, this is probably the most affordable in terms of margin required for trading US equity index. Okay, so the current value is at just above 2,000, and you can see the overall trend is very bullish. Very similar to the Nasdaq Composite Index, the low of 2009 remains unviolated. Okay, that means to say that Nasdaq as well as the Russell 2000 has been very durable in terms of the bull market. The bull market low at the March low of 2009 remains the defining moments, whereas the S&P 500 and the Dow, okay, the mini crash that we saw back in March of 2020 has actually erased the bull market outlook. Okay, and the new bull market has actually developed at the end of March 2020. Okay, so when you look in perspective between the Nasdaq and the S&P against the, let's say the Dow and the S&P 500 against the Nasdaq and the Russell 2000, you can see that the later two has been the most durable bull run so far. Okay. Now this is the weekly time frame. You can see that we are definitely seeing a counter trend. So far, the move from the high of 2,458. Remember, the high traded for this was November of last year. So this year we do not have a new high traded for the Nasdaq. We don't have a new high traded for the Russell 2000. The high was actually November last year. And so far, the move down has been three wave, meaning to say that it has so far been corrective, meaning from a high of 2,458 all the way down to 1,900. That move has been three wave and is corrective looking. If it accelerates to the downside, there's every possibility that it may even test 1,700. So that is a more serious bearish outlook if you look at purely from a chart point of view. Okay. Now in the March futures contract, you can see that the move is clearly three way from the high of 2,460 down all the way to just under 1,900 in the futures contract. So right now the market is easing off again and is bordering just above the 2000 levels. If it's slight below the low of 1900, there is very good chance that it will slide all the way down to 1700. That will be a key level to watch. The immediate support is at 1875 and 1818. So these two levels must hold for prices to stabilize, but I am not optimistic. Now, this is the crude oil. This is the continuous chart, meaning you said I use the active, the regular crude oil price chart to show you the longer term outlook. You can see that the price went up to a high of $147 per barrel and down to negative $40, which is an aberration in my opinion. Okay, something as precious as crude oil shouldn't go into negative. There is simply no logic. However, you can see that the market has been surging since. The price as of last week was at $93. Okay, currently as of last night, it closed above the $90 per barrel, and it's looking like it will likely challenge the $100 per barrel in no time. Okay, so this is something that you want to watch. The high, the record high that we know of is traded at $147. So on the upside, it is not impossible for crude oil prices to be priced way above $100 because it has happened before. Okay, so this is the futures contract for the March light crude oil. Of course, this is something that the regular contract, not the micro contract. Okay, this is give you an idea how the price has been looked at. You can see that the price last traded was $92 this afternoon, and year to date is up 22%. And this is fantastic because we are only into what the 6 week of trading, and crude oil has already gone up by 22%. Fantastic. Okay, the next level to watch out for will be $111 and $121. So both levels are targets that is looking very positive. Okay, and on the downside, I don't think the price can slide back to $75 anytime soon. So more to the upside, what are the likely targets will be $111. So now next I'll be showing you the micro E-mini, which is something that you can afford to trade. Last traded was $91.22. Like I said, very similar to the outlook for the weekly time frame for the regular contract. There is no counter trend. You can see the boxes are all green in color, and meaning to say the market is very bullish. And you can see that there's a rising channel in which prices have been confined within. And so long as the price stays within this rising channel, I think we are going to see likely to see higher prices ahead. Okay, the nearby support is at $82. Like I say, I'm not optimistic that we can see this level anytime soon. More to the upside. Now we're covering the equity, the FX contract. This is the OTC market, which is the regular FX contracts. The euro dollar by far is the most actively traded currency pair. Now for anybody who have been trading currency, now value of a currency can only be compared when it is compared to another currency. By itself, we do not know the value of any currency unless we use it to compare against another currency. So they need two currencies. So it's like a yo-yo, you know, it's like a seesaw. So if the price of one currency rises, the other one will automatically go down. Okay. So when you see euro versus the dollar, it means the euro is always fixed at 1, the unit 1. So what move is always the currency on the right, what we call the quoted currencies. In this case, euro is the base currency and the dollar is the quoted currency. So what goes up and down is actually the dollar going up. So if you requires more US dollars to purchase the same 1 unit of euro, it means that the euro has appreciated, the dollar has gone down, vice versa. Okay, so the last price as of last night's closing is at 1.1442. It means it requires $1.14 to exchange for 1 unit of euro. So you can see that from the monthly time frame, the euro is in a long-term decline. Okay, the high traded was 1.6. Okay, and now it is trading at 1.4. Okay, 1.14. So it has come a long way from 1.6. But you can see at the euro is only a more recent phenomenon. We can see that euro was only launched in the early part of 1990s. In the early days when we was trading currency futures, there was no euro. There were Deutsche Marks, there were French francs, there were Italian lira. So those currencies are no longer, so they have all been trading the euro itself. So you can see that the euro has been falling. In the higher time frame, you can see that the euro is definitely in the long-term decline. So in the weekly time frame, we can see that the rebound from the low of 106 back to 1.23 half is actually a technical rebound, and the prices has since slide back to 1.111. So we can see that long term the euro has come back down again. So if you use this as a guide, there is always the potential for whatever reason the euro to go back to 1.28 half to 1.3120. Okay, so that level is definitely, you can see this area where I shaded in pink color, that is ideally technically an ideal target to re-engage on the sell side for the euro. Okay, but prices needs to work out over time. Right now, the fundamentals does not favor any sustained rise in the euro. Although last week we have seen a surge in euro purely because inflation is at a record high, and market participants are expecting the ECB to go back on their words and to high interest rate. So that was the reason behind the late surge in euro last week. Okay, so if you have been short the euro versus the dollar, when you have market participant expecting the ECB to change stance from dovish to hawkish, then obviously you want to unwind your short position. So I believe the bulk of the surge in the euro versus the dollar has been the unwinding of shorts rather than new position buying the euro. Okay, because when you look at the fundamentals, everything is wrong about the euro, whether you're looking at the economics or whether you're looking at the geopolitics. Not a very comfortable thing to be buying euro knowing the fundamentals. Okay, so you can see the micro e-mini euro dollar FX March contract. Okay, you can see the surge coming in. You can see that the market went from 111 to 115, very sharp move, and this week it started on a slightly softer note. There was no follow through buying as of this afternoon. Okay, so by and large you can see technically the market has broken out of a declining channel, and maybe there is some kind of technical rebound going forward. So if you can see prices trading above 1.16, that will be a good news, and I always want to maintain the view that it is a higher level to sell rather than to buy. Okay, now when you look at the other major currency pair, we have sterling versus the dollar. Here the base currency is sterling, which is the UK currency, and the quoted currency is the dollar. So it's exactly very similar to how the euro dollar is being conventionally quoted. Okay, so you can see the money time frame, the sterling is also in a long-term decline. Okay, the highest ever traded for sterling was back in 1972 at 2.64. So you can see the sterling has come a long way down. It even went very close to parity back in 1985. Are we able to go back and see back this price? I think over the long term, there's always a very good candidate for the sterling to go back to parity. Okay, because the UK of today is no longer the same UK of 100 years ago. So previously, before World War, in fact, the UK currency has been coming down since the end of the First World War, and after the Second World War, you can see that the UK is no longer the same dominant power than in which they used to be. Okay, and of course you can see in the currency itself, the sterling itself has been worth a lot lesser now relative to the dollar. Okay. Now in the weekly time frame, you can see that the larger time frame is pink in color. We have seen that this is a major bear market, and what we are seeing from the low of 1.14 all the way up to 1.42 half is basically a rebound. Okay, so right now we can see prices easing off a bit. Okay, relative to you can also trade the euro versus the sterling, but as a futures contract in the FX contract, you will have to look beyond the futures. Okay, but you can do crosses as well. Okay. So this is the March contract for the sterling. You can see that prices has been having higher lows, and we have lower lows until most recently. So if there is a technical rebound, very similar to the euro dollar outlook, in the medium term, there is always opportunity for the market to rise back to 1.39 to 1.40. Okay, that pink shaded area is the ideal place to re-establish short position for sterling versus the dollar if the market can go up there. Okay. The Aussie dollars has been getting a lot of attention of late because it is a commodity currencies, and commodity is having a good run since last year. And we can see the commodity prices goes up. Obviously, it's going to benefit the commodity currencies, of which the Aussie dollars is one. Okay, so this is the monthly time frame. Is also looking long-term bearish. So what I've shown you so far are three pairs of currencies versus the dollar. It means all the currencies are in a long-term decline, meaning to say over the longer term, the dollar is a long-term buy. Okay, so looking at the statistic, looking at the numbers here, we can see that this is definitely a bear market, and the rebound from 55 cents is definitely the low so far. And is it a possibility that we can see lower prices? It's a bit of a mix, because on the one hand, you have rising commodity prices, which theoretically should support the value of the Aussie dollars. On the other hand, a rate tightening cycle should also benefit the dollar. So we have two competing forces that favors both the Aussie and the US dollar. So maybe it will not be the best currency to trade, because you have two forces that may actually neutralize each other. Okay. This is a weekly time frame. You can see that the market is in a bear trend, and this is the rebound that we are seeing. The bottom so far is at 63 cents, 64 cents, and the market has been a cap at 80 cents. So anything above 80 cents has always been acting as a major resistance. Back in 2019, you can see that 81 cents has been a cap, and then over the last 2021, you can see 80 cents has been the cap. So by and large, you can see there's a cap on the Aussie versus the dollar rate. Now this is the micro Aussie dollars March contract. You can see that this is definitely trading within a narrow trading band. Okay, so in terms of trading activity, it is by far not the best choice to trade because the trading ranges is on a relative basis definitely more confined compared to the volatility seen in Aussie dollars, as well as in the euro dollar and the sterling versus the dollar pair. Okay, so I have covered, I think, a bit of overrun. Right now we are in that segment where I'm open to your questions. So if you have any questions, do pop in into the chat box, and we'll try to tackle them as using the remaining times.
All right, ladies and gentlemen, now's a great time for you to send your questions in the question box, and we'll get our professional trader, Daniel Ang, to give us his views on that. All right. We have the first one from Fran. Thanks for the prezo. That's from Fran. He's saying that Daniel, you're obviously a bear. So what would you trade to stay ahead, Daniel? What's your thoughts?
Okay, I think the major thing for me, knowing what I know, because the news has already been in place. In fact, the fundamental has been unfolding on a day-to-day basis, and there's nothing new there. We all know that the US equities are in very rich valuation. I'm not saying that we are going to enter a bear market, but what I'm saying that the market is due for a significant correction. Okay, and I think it may happen as early as this month, and it may stretch all the way to the month of March. Okay, overall, the bull market in US equities remain intact. Okay, if you use the Nasdaq as well as the Russell 2000 as a guide. Okay, like I said, both indices has been very durable in terms of the bull market outlook, unlike the Dow and the S&P 500. So I do see a significant correction, and I think the high for the year is possibly already in place. Okay, so going forward, I do see lower valuation going forward. So as far as US equity index is concerned, I am a bear, okay, for the corrective pullback that I'm expecting. Okay, so this is how I will position myself. I'll be looking for opportunity to sell equity index whenever I get a sell signal, and I'm definitely going to look to for levels to buy dollar, because I do believe all other currency, especially the euro, is not in a very good place right now. Okay, the fundamentals are weak. On top of that, you have this issue with the Russia and Ukraine border. So all this, if they ever come to pass, is definitely a negative for the euro currencies, and definitely a plus for dollar, because if there's tension, capital has to flee. Once they flee, they will go into safe haven currencies. Where else would they go? Obviously, within Europe, I would think some of the capital will flee to Switzerland because it's the Swiss franc has always been a safe haven currency. The other one obviously will be the dollar. Okay, so the dollar has always been a safe haven currency in time of geopolitics tension because US is not in mainland Europe and is across the Atlantic. If anything bad should happen in the mainland Europe, definitely US is definitely on a relative basis a safe place to park your money. So I'll be looking to sell equity index. If I get a sell signal, I'm looking to buy US dollars if I can get a buy signal, and I'm definitely going to look at buying energy products if they ever pull back to a sensible level. Okay, so by and large, the outlook for me is very simple. These are the main theme. Okay, sell equity index, buy dollar, buy energy products, maybe even buy precious metals, because we can see that of late there's a lot of news talking about places like Austria, places like Spain, places like Canada, even Australia. We can see there is a rising tide of protests against the vaccine mandate, and that will cause a lot of tension, and that will be the catalyst, I believe, not so much on inflation, that will cause a spark in precious metal markets.
Right, then we got a few questions lined up. I'm gonna fill them to you, maybe 2 or 3 more of them, as much as we have time for. While you're on the subject of precious metals, what's your view on COMEX gold, and where do you think it's headed in the near term?
Okay, last year we can see that silver has underperformed relative to gold, but this year we see a bit of a switch. Silver has been performing a lot better than gold so far. My bet is to accumulate precious metal position. Last week I started to buy silver, and silver prices has gone up a little bit so far for the last 48 hours. Hopefully it will continue to go up. So like I said, the only reason why I think precious metal is going to rise is not so much of as a hedge against inflation. It has not performed the role for the whole of last year, and I don't expect it to perform the same the traditional role as a hedge against inflation going forward. More of the unrest that we are seeing, because right now we are seeing a worldwide movement. If you can see the Freedom Convoy in Canada, that has created a lot of excitement, and it's going to have a lot of copycats. And very soon, I think if that continues, if the truckers protest and not delivering products into where they should be, whether it's their warehouses or supermarket, we're going to see an aggravated inflation situation, because if foods are not delivered to supermarkets, food prices is definitely going to escalate. And if the truckers are not delivering important parts to the factories, products are not going to get made. Okay, so overall we're going to see that a deepening of the inflationary situation in which we are in. Okay, and that is going to cause the precious metal market to actually rise because of the reawakening, so to say. Okay, the fight back against the vaccine mandate.
All right, from gold, now I'm gonna ask you a question about the Swiss franc. Where do you think the Swiss franc will head? Is it going to go up when the US dollar is getting more expensive?
I think both will go up. Okay. The other thing you have to worry about is Swiss has a negative interest rate of 0.5. Okay. So if you look at interest rate alone, definitely between the US dollars that is likely to rise in the near future compared to a negative interest rate that is negative 0.5%, the option is actually very clear. Between the two, I will opt for US dollar rather than Swiss franc. Swiss franc is definitely not so much to earn a yield. Okay, Swiss franc is a safe haven currency. In time of trouble, you want to put your money, not so much for it to appreciate, but at least to hold on to its value. Okay, so Swiss franc, as far as Europeans concerned, is definitely a lot more accessible than putting the money in the States. Okay, so between the two, purely from the yield perspective, I think the dollar is a better bet.
So Daniel, there's a significant drop in Facebook and Netflix. Do you see the Nasdaq suffering from, dropping way further with more impact to the tech sector?
Well, Facebook definitely have it bad this year. Okay, they have lost 29% of its value in just one day. Okay, and today, last I checked, is still falling. Okay, that being the case, however, the Nasdaq has been compensated by the earning reports from companies like Amazon. So basically, if the other major FANG stocks also fall, okay, or have missed their earning estimates, then yes, the Nasdaq is very vulnerable. But by and large, looking from the technical point of view, I am looking for levels to sell, honestly.
All right, we're gonna go to the last question now for those questions. Thank you for all the questions once again. For those questions that we didn't have time to answer, I'll try to reach Daniel, to get in touch with Daniel tomorrow, and we'll try and get his views on the questions that we were unable to answer during this webinar. All right. So the last question is, which is timely for like a summary to wrap up the event. Which index or indices are you more inclined to short based on what you've shared today? The Dow, S&P, Nasdaq, or the Russell 2000?
My rule of thumb has always been very simple: sell the weakest, buy the strongest. Okay, for let's say for those who are unsure as to which direction the equity index is like to move, this will be a good strategy. Okay, right now we know that the two weakest are the Nasdaq 100 and the Russell 2000, and the two relatively firmer index are the Dow and the S&P 500. The Dow being more firmer than the S&P 500 currently. So if you have to take a view, okay, if I have to take a view, I will definitely be more keen to sell the Nasdaq as well as the Russell 2000, provided it can rebound significantly or at least meaningfully. And then on the other hand, if I have no view, okay, then I can do what we call a spread. We can sell the Nasdaq 100 and Russell 2000 against, let's say, the Dow, for example. Okay, so those are options you can use. Okay, for those who have no particular view but wanting to sit on the fence and hope for the best, and you always sell the weakest, buy the strongest. That should be able to give you some kind of yield. Okay. Now, for those who have more questions than we have time for, do know that every Sunday I have a free to attend webinar called the Weekly Market Wrap. At the bottom of that, you can see there's a link there. So for those who are keen, you can just copy this link and join me every Sunday, or follow my Facebook page for updates. I will update my Facebook page on Saturday to give you the latest link, but the link remains unchanged every Sunday. Okay, so if you have more questions, I will cover a lot more during the 2 hours of Weekly Market Wrap. And of course, if you have question that you still want to reach out to me, you can reach me at these two places. You can email me at support@tradersacademyonline.com. Okay. The other one, of course, is my website.
All right, what you see on the slide there is Daniel's book, which I accidentally bumped into at the bookstore and went, hey, I know that guy. That is Daniel Ang, and that's his book. Once again, thank you for being a wonderful audience, and Daniel, thank you for your views. We have some unanswered questions, which I will reach out to you and get your views on tomorrow. All right, thanks for being a wonderful audience, and until our next live webinar, take care and stay safe. Bye-bye.
Thank you very much. And 恭喜發財啊!
Happy New Year, Daniel.
Thank you very much.